Starting now, you can get a transcript of each week's Rich Dad Radio Show. Just visit www.richdad.com/radio and download a copy today.
This is the Rich Dad Radio Show. The good news and bad news about money. Here's Robert Kiyosaki.
Hello. It's Robert Kiyosaki, the Rich Dad Radio Show. The good news and bad news about money. Today's show is about the future. So let me ask this specific question because the future is kind of boring unless greed enters into it. So let's say I told you that gold was going to be $10,000 an ounce, and today with royalties and all that, it's about $1,400 per coin. And today silver's about $17 an ounce. So if gold goes to $10,000 an ounce and you could see it, what would you do? I mean, would you buy more stocks? Would you put it in the bank? You know, if you knew that gold was probably going to go up near 10 times, what would you do? And that's what the future is good for. Can you see the future? And so today I'm honored beyond belief. You know, like I've had two major honors prior to this. Number one was being on the Oprah Winfrey Show. You know, she promoted Rich Dad, Poor Dad. And number two was to write two books with our now president, Donald Trump. Now, in some circles, that's a plus. In other circles, it's a minus. But today, it's about the future. And we have, in my opinion, the greatest futurist of our time today. He's come in via phone or the web, whatever it is. But today, I'm very honored to have James Rickards in studio with us today. And Kim knows I'm just like a little kid running around the place excited, right, Kim?
Oh, you're a hero of Robert's, Jim, and he's been walking around the house for months with his headset, listening to The Road to Ruin. I mean, he'll go to sleep listening to it. He's a huge fan.
And by the way, I did read the book, but the reason I read the book and then I listen to the audio is because, and I thank you for reading it personally, because you pick up a lot of information just from the tone of voice, the inflections and things like this. So The Road to Ruin, I estimate I've listened to it 14 times on the headset, and it takes about 2 weeks to get through it, listening to it 14 times. You know what I mean? It's a lot of work. But every time I picked up something that I missed. And so for all of you who are listening is that one of the ways we learn is but via repetition. And one of the reasons Rich Dad Company was formed because we could see this crisis coming. You know, back in 1983, when I met Kim, I was studying a man named Dr. R. Buckminster Fuller, who was also a futurist. And Fuller was predicting the coming of this era we're in now. And we're in a crisis era right now. So it's very much of an honor to have James Rickards, the Chief Global Strategist at Merrick-Lim. He's also a New York Times best-selling author and economist, which I think is funny because you're really an attorney. And he was with the I remember when LTCM, Long-Term Capital Management, came down, and Kim and I were out in Thailand at that time, and the whole world was coming apart, but it was started by the Russian ruble and all this other collapse coming around us. I don't know how anybody can sleep at night. So anyway, I want to welcome to the program, and it's an honor. I'm humbled. James Rickards, he's the author of The Road to Ruin, The Currency Wars, which is the first book I read, The Death of Money, New Case for Gold, and The Road to Ruin. So welcome to the program, James.
Thank you, Robert. Thank you, Kim.
Welcome, Jim.
It's great to be with you. You know, Robert, we've met a few times in the past, and I've done the radio show with you and Kim in the past, you know, remotely. But to actually be here at your headquarters, be in the studio, face to face, it is such a thrill. It's such an honor, and also had the opportunity to meet your staff and folks around here. What a great group of people. So congratulations on your success, and it's just a thrill to be here.
Thank you, Jim.
And the same goes for your daughter, Allie, because I remember in Road to Ruin, you talked about how you went to dinner with three powerful women, and Allie, named Allie, was one of them. And I said, God, I've got to meet her. So I met her this morning, and it's just really one big happy family.
Well, she keeps trains running on time. She's brilliant. She's my wears a number of hats: my business manager, my social digital media strategist, and a lot else besides. So I couldn't make it through the day without her.
Correct. And now, see, I wouldn't call Jim Rickards a best-selling author and economist. I call him a futurist. And he talks about the raven. Raven is the god of the future to Apollo, I think, something like that. But you called for 10,000 an ounce gold, and today it's around 1,400 per U.S. Gold Eagle. So it's not the price of gold. You see, I could sit up there and say, well, gold's going to go to $1 million. But you learn nothing. You just have to you have to drink the Kool-Aid to go buy it for that. But the thing I loved about the road to ruin was the logic, the research, the analysts, the historical real-life experiences that you went through to come to this number called 10,000 an ounce. So right now I'm going to say it to you again. If you knew it was going to hit 10,000 an ounce, and we're not saying it is, so don't go and do it just because of this. What I want you to listen to is how James Rickards came to the conclusion that today it should be $10,000 an ounce. So please, don't go out and buy it just because there's a number on it.
And Jim, just in case people don't know your background,
Oh, yeah,
I mean,
good.
you've consulted with the IMF, the International Monetary Fund. You've consulted with all the major central banks. I mean, a little bit of your background.
Sure, and Robert's right. I began my career as a lawyer. But before I went to law school, I got a graduate degree in international economics from the Johns Hopkins School of Advanced International Studies, the NITSA school, which is ranked number one. So I had a deep immersion. And interesting thing about my class, I was there in 73, 74. I was the last class. My class was the last class that was taught gold as a monetary standard. Everyone says, the gold standard ended in 1971 when Nixon suspended redemptions. It was a big deal, but it lingered on for a couple of years after that, because what Nixon said, if you go back and look at that speech, and it's available on YouTube, he said, I am temporarily suspending the conversion of dollars into gold. And there were 5 people up at Camp David that weekend, and I've actually spoken to 2 of them personally. Kenneth Dam, who was in the White House, Nixon White House at the time, and Paul Volcker, who was the Deputy Secretary of the Treasury. And they both said to me, we thought it was temporary. They really did. They knew they had to devalue the dollar. They knew the system wasn't working. They would temporarily suspend redemptions, have another monetary conference, sort of like Bretton Woods, devalue the dollar, and go back to the gold standard at this new value, which was about $42 an ounce. But the plan never came off. While they were negotiating and doing that, one by one, countries started going to floating exchange rates, and then the cat was out of the bag. They couldn't stop it, and the French were the last holdout. They wanted to go back to gold, but we never did. So sure, 45 years ago, we're still not back on the gold standard, but they really did think it was temporary. But my point is, it took a few years for that to happen. So when I was in graduate school, the IMF was still treating gold as a monetary asset. We learned gold. And my professors, so let's say I had a 55-year-old professor in 1974. Well, these were the young guns of Bretton Woods. These were the academics, the 25, 30-year-olds who were running Bretton Woods through the 50s and 60s. So
for those who may know what Bretton Woods was, it was a conference in 1944 where the world got together. The U.S. dollar became the reserve currency of the world. In other words, the dollar was as good as gold as long as the U.S. pledged to keep about 20% of its dollars in gold, something like that.
That's exactly right, Robert. So the Bretton Woods, named after a town in New Hampshire, and it was the Mount Washington Inn, very remote location. Actually, it was a friend of Franklin Roosevelt's who owned it, so he said, let's have the conference there so my friend can get some business. But it really is in the middle of nowhere. But there were competing plans, but the U.S. plan was we will lock the dollar to gold. So the dollar was going to be $35 an ounce for gold. That was fixed. All the other currencies were linked to the dollar. They were not linked to gold. They were linked to the dollar. Now, indirectly, you had a linkage to gold. But you could, if you were under distress, you could go to the IMF and get permission to devalue your currency against the dollar. The one thing that couldn't happen was the dollar could not devalue against gold. That was the anchor of the whole system. And that's what Nixon busted up in 1971, although, as I say, it took a few years for that to play out. So I learned all this history, and then I always say if you're younger than I am and you know anything about gold, you're either self-taught or you went to mining college, because they literally stopped teaching it in the universities. There's no economics department today that teaches you anything about gold. So like I say, you have to sort of educate yourself if you want to know about it. But so that's a little bit of my background. Then I went to law school, had a long career in banking. So 10 years at Citibank, 10 years with a major investment bank. There was what they call primary deal on government securities. That's when I really learned the government securities market, derivatives, start to finish with the hedge fund, long-term capital management. I was, like I said, I was the lawyer, not the risk manager, but When it all fell apart in 1998, in that scenario you described, Robert, which did begin in Thailand, began in Thailand in 1997, 97, spread around the world. But the interesting thing about that, so it starts in June 97 in Thailand, comes to a head in September 1998 in Greenwich, Connecticut, which is where we were located. We were hours away from closing every stock and bond exchange in the world. And people don't realize how close it came. That's no exaggeration.
One hedge fund called LTCM.
One hedge fund called Long-Term Capital Management, right. LTCM, exactly. But the thing is, it wasn't just the hedge fund. We had $1.3 trillion worth of derivative contracts with Wall Street, with what I call the 14 families, all the major investment banks. So
all the investment banks had some of your products.
They were our counterparts. That's exactly right, Ken.
And that's called counterparty risk.
Counterparty risk, exactly.
That's a very big word, counterparty risk, because when we go back to gold doesn't have counterparty risk.
Gold is just gold. It's not a contract. No one has to perform. No one has to be good for it. No one has to pay off an IOU. It's just gold, and that is one of the attractions of it. So we were our firm was melting because of this crisis. We were getting close to zero, but the point is, I said, look, if we file for bankruptcy, if Long-Term Capital Management files for bankruptcy, and I was the lawyer, I said, I'll just sleep in the next day. I'll go get another job, right? But you, Wall Street, are going to have to deal with the $1.3 trillion of counterparty risk, because the way it works is, so you're a bank, so you're long, short, long, short, long, short, you're a buyer and a seller, and you're making money on the spread. So you've got, in the aggregate, as I say, over $1 trillion of contracts with us. If you take us out of the equation, we file for bankruptcy, we go away. All of a sudden, you no longer have a balanced position. You're on one side of the trade. What you thought was your hedge just disappeared. So now you have to go into the market to reconstitute that hedge. But that was what the government was worried about. That's
a hedge is kind of like an insurance policy.
Correct. I own something, but I'm worried it's going to go down, so I do something else to protect against that risk. That's a hedge. That's exactly
it's like you buy a piece of real estate, you buy insurance in case the real estate burns down.
Correct. Title insurance, homeowners insurance, et cetera.
When Long-Term Capital disappeared, they could no longer go to. They could no longer go to you to.
We couldn't perform our side of the contract, which meant they had to go out and hedge. They thought they had a hedge position, take us out of the mix. All of a sudden, you're unhedged, and they would have to go out into the market and hedge. So nobody really cared. They didn't bail us out; they bailed themselves out. So by putting more money in and supporting the balance sheet, we could then go ahead and perform on all those contracts. But
it's really a horrible story when I read about it. Is the banks came in and screwed you guys again, even worse.
Yeah, we were. Look, we lost. By the way, most of that money was our money. There was about $4 trillion of losses, but $2.6 trillion of that was our money. They put the $4 billion in, so then the balance sheet was solid. We spent a year unwinding the trades, but unwinding it gradually is very different than unwinding it all at once. When the Fed came up to Greenwich to visit our offices, Peter Fisher, who is the head of market operations at the New York Fed, we went through the books. We were very transparent. We said, hey, this is not about us. We didn't think we were going to get bailed out. In fact, we didn't. As I said, they bailed themselves out. But we went through position by position. And when we were done, it took hours. And Peter looked up at me and John Merriweather and said, I knew you guys were going to take down the bond market. I didn't know you were going to take down the stock market, too. We had $15 billion worth of open stock positions. And again, there's not that much liquidity in the market. So that's what that was all about. But my point being, I went on. I ran a stock exchange. I worked for the CIA for about 10 years doing what we call market intelligence, or MarkInt, using financial analysis. We can talk about that. But so a bit of an eclectic career.
But you've also worked for the Defense Department.
Defense Department.
And that's where currency wars came from.
Correct. And, Robert, I take, when you describe me as a futurist, I take that as a very, very nice compliment, because I've actually met a number of futurists, because you mentioned Buckminster Fuller, Alvin Toffler, but I worked with the chief futurist at the Pentagon. His name was Andy Marshall. He's still alive, but Andy served 8 presidents. He was appointed by President Nixon in the early 1970s and worked all the way through the Obama administration. He retired about 2 years ago before Trump, but that was a total of 8 presidents. When I met him, he was 92 years old. Interesting, a 92-year-old futurist, but maybe the more you know about the past, the better you are at the future. But, sharp as a tack, and his job was not to look 6 months or 1 year or 2 years down the road. His job was to look 5 or 10 years down the road, think about the future of warfare and what the Pentagon needed to do. So I was meeting with him about financial risk. And I said, I said, Mr. Marshall, I said, the time may come when a U.S. destroyer pulls up to a fuel dock in Singapore and you say, fill her up, and the operator says, fine, pay me in SDRs. Those SDRs are special drawing rights. This is world money. It's not complicated.
It's like a
Not the
one
US
world
dollar.
currency.
One world currency, that's exactly right. Not the U.S. dollar, and that's the key point. And I said, for the first time, you're going to have a very expensive forward deployed military that you have to pay for in a currency that you don't print.
So that's why we're here listening to James Rickard, again, author of The Road to Ruin, Currency Wars, The Death of Money, and the New Case of Gold. And again, the question is, if you knew that gold was going to go to 10,000 sometime in the future, and we're not saying it is, and today gold's at $1,400, what would you do? And that's the power of seeing the future. So when we come back, we'll be going on further with James Rickards to find out his logic for the calling of $10,000 an ounce gold.
You're listening to the Rich Dad Radio Show with Robert Kiyosaki.
Don't be like Charlie. Charlie is that do-it-yourselfer who does himself in. Do-it-yourself is good for tile and grout. It is not good for asset protection. Charlie thought he'd save a few dollars forming his LLC online. With no guidance, he did it wrong. When he sold the property, he lost thousands and thousands of dollars. He did himself in by trying to do it himself. Don't burn yourself. Use Corporate Direct to set up and maintain your LLCs and corporations. Corporate Direct is owned and operated by attorney and rich dad advisor Garrett Sutton. Garrett wrote the bestsellers Loopholes of Real Estate and Start Your Own Corporation. He is Robert Kiyosaki's attorney for asset protection. He and his team will do it right. Visit them at corporatedirect.com or call 800-600-1760. Mention Rich Dad and receive $100 off your formation fee. That's corporatedirect.com. corporatedirect.com.
Log on to richdadradio.com while you listen. Now back to Robert Kiyosaki.
Welcome back, Robert Kiyosaki, the Rich Dad Radio Show. Good news and bad news about money. We have, in my opinion, the greatest futurist of our time sitting in the Rich Dad office. I started with this book, Currency Wars. I moved up to The Death of Money, The New Case of Gold, and then The Road to Ruin. But anyway, you can listen to the Rich Dad Radio program anytime, anywhere on iTunes or Android, and you can go to richdadradio.com because all of our programs are archived. We archive them because repetition is how you learn, and you learn best. So you can go to richdadradio.com, download this interview with James Rickards, who was in Rich Dad's studio. It's such an honor for me. And listen to it again and again, but most importantly, have your friends, family, and business associates listen to it because it is about the future. And the tease I put out there was if you knew an ounce of gold was going to go to $10,000 an ounce, and today it's $1,400 an ounce, would you leave your money in the bank getting 1.2%? That's kind of the question we're asking. Any comments, Kim?
I love the subtitle of The Road to Ruin, The Global Elite Secret Plan for the Next Financial Crisis. And somewhere in this show, we have so much to talk about. I'd love to know, what can you as a listener do to prepare for this coming financial crisis?
How many times did I listen to Road to Ruin?
100 probably. I don't know.
I was walking around. I look like Mickey Mouse with these headsets on Bluetooth listening to, because I can pick up from your inflection and your tone and, the emphasis you put. So thank you for reading The Road to Ruin versus let somebody else, which is what I do, read the book. So we're going back again. We're going to $10,000 an ounce gold. We're not going to give you the answer yet, but we're going into the logic of why you came to that conclusion. What do you see that's coming?
Well, you put your finger on it, Robert, which is the logic and the analysis behind it. I don't like to debate claims because you can debate them all day long and not get anywhere. So I have a medium-term forecast of gold at $10,000 an ounce. My friend Harry Dent says $800 an ounce. Well, those are two claims. So you can yell 10,800 all day long, but it's just two guys debating claims. That doesn't get you anywhere. What I say to Harry, and we have debated this, is, Harry, what's your analysis? How do you get there? And then ask me, in all fairness, Jim, what's your analysis? Then you can debate the analysis and the methodology, and you're much better informed. You can form your own opinion based on that.
Makes a lot of sense.
That's what I like to do, is kind of look behind the numbers a little bit. But where it starts, Robert, is look, they're all different forms of money. So the dollar is money, the euro is money, Gold is money, silver is money.
And Bitcoin.
Bitcoin is money, and at various times and places in the past, feathers, shells, beads have all been money, digital money, credit cards, debit cards. These are all forms of money. And then people say, well, they're not backed by anything. The dollar is not backed by anything, or Bitcoin is not backed by anything, or feathers or shells are not backed by anything. But they're all backed by one thing, and it's the same thing, which is confidence. If you have confidence that it's money, then it's money. If I give you, some shells or something, and you're confident that you can give it to the next person, they'll accept it in exchange for goods and services, then it's money.
Which is kind of what's happening with Bitcoin right now. I mean, we're not going to go into that whole discussion, but there's people that are very confident with it and people that are not confident with it.
Right, and that's the point. So obviously the more confidence, the better. So if a large group of people are confident that they can take money from me in exchange for goods and services and turn it around and give it to the next person, then it's money. I don't care what form it takes. The point is, confidence is fragile, it's easily lost, and almost impossible to regain. And so the question is, how confident are you in a certain form of money, and are there threats on the horizon that could destroy confidence? And then I always like to go a step further to what I call the reaction. Don't just forecast a bad thing. Let's say, what's the response? What are people going to do in response to that? And just play it out and see how it goes. Most people ask one or two questions, but they don't ask 4 or 5 questions, and really go all the way down the line. So it's all about confidence in the dollar. That's the main.
May I give you my mantra?
Please.
Money is an idea backed by confidence, representing work truly done, and is exchangeable.
Yeah.
I run that in my head.
That's it.
The key word is confidence, and it's exchangeable. If
Key
you
word
lose
is
those two things, you're finished.
Confidence. And confidence is just a Latin form of trust. With fide, faith.
Also fiduciary.
Yeah, confidence with faith, fiduciary. And that's what makes money.
And the dollar's in trouble. That's what you're saying.
The dollar is going to be in a lot worse. It's getting in worse trouble, and it's going to get a lot worse
and
from
that
here.
affects gold.
Correct. Now, go back 1977, Jimmy Carter's president, and very few people know this. In 1977, the United States Treasury issued treasury bonds, denominated in Swiss francs. That's how quickly confidence was collapsing in the dollar. Now, we turned it around. Paul Volcker, Ronald Reagan, higher interest rates. There was a whole. We were crashing. The plane was crashing, and Volcker and Reagan kind of grabbed the joystick and got it out of the dive and got it back,
to the King
back
dollar
up
standard.
in the gear again. Then it became the King dollar standard in the 80s and 90s, all the way through to not that long ago. But imagine the United States Treasury. People saying, "I don't want dollars. I'll take Treasury bonds, but you've got to put them in Swiss francs." Not dollars. That happened. They were called Carter bonds. Very few people know that. So we've seen a close brush with a loss of confidence in the dollar in the late 70s, and we're seeing one again. And so the thesis behind gold is, okay, if people lose confidence in the dollar, and you've got to restore confidence, you're in this nosedive again. Who's the new Paul Volcker? Paul Volcker's still alive and well. I see him occasionally in New York, but he's not going to be the guy to save the world the next time. How are you going to restore confidence in the dollar? And one way to do that is with gold. If you said, okay, well, now we're going to have a gold-backed dollar, even if it's not a hard gold standard, we're using gold as a reference. We're putting gold back into our monetary policy considerations. That will restore confidence. Then you have to ask yourself the next question, okay, what's the price? Because, one of the criticisms of gold, people say, well, gold can never be a monetary standard.
Barbaric relic of the past.
Barbaric relic of the past, which, by the way, John Maynard Keynes never said. I
understand.
I dug into that one
he
also.
He said the gold standard.
Correct.
The standard was the gold.
He did not say gold was a barbarous relic. He said the gold standard of the time. And he was right about that. That was a mess. But
see, I read your book.
Well, thank you. Yes. And so the question is, if you restore confidence, if you use gold to restore confidence, which I do see coming, you have to ask yourself at what price. Because if you get the price wrong, it can be highly deflationary. It can make things worse. And people say, well, we can't have a gold standard because there's not enough gold. You hear that all the time. Maybe it worked in the 19th century. Maybe it worked until 1971. But since then, the global economy has expanded drastically. We're into trillions of dollars. The supply hasn't gone up that much. So we don't have enough gold to support trade and commerce today. And I say, nonsense. There's always enough gold. It's just a question of price. If you take the supply of gold, the official supply of gold at $1,300 an ounce, which is about where it is now, and that has to support the money supply, that you'd have to shrink the money supply by 80% to make that work, and that would be deflationary and depressionary. But all you have to do is mark up the price to a higher level, and then with the same amount of gold at a higher price, you can support a larger money supply.
And that's what Roosevelt did back in 1933.
It's exactly what he did, Robert, and he did it for a reason that the Fed is now wrestling with, which is how do you cause inflation. So 1929 to 1933 was the longest period of sustained deflation in American history.
And deflation is depression.
Deflation is depression. Deflation, actually, the best performing asset in deflation is cash, because prices are dropping. And so if you have an amount of cash and prices are dropping, you get more for your money. So the person who holds cash is the king of the hill. The problem with that is everyone realizes it and they hold on to cash and don't spend it. If cash is going up in value because prices are dropping, people won't spend the cash.
That's correct.
And then what happens? Prices drop more. And the
That
question
means
is,
if you knew a Ferrari was not $200,000 this today, but it'll be $100,000.
you would wait.
You would wait for it to drop
You
to
wouldn't buy,
$100,000.
but if everyone's hoarding cash and not buying, what's happening to the economy? Prices are dropping more. This is what Keynes called the liquidity trap. Everybody wants cash, nobody wants to spend. So Roosevelt said, how do I get people out of the liquidity trap? And the answer was, I can devalue the dollar, but against what? The sterling, French francs at the time, Japanese yen. No, because that was the currency where they were devaluing against each other. He said, I've got to do it against gold. Now, everyone says Roosevelt raised the price of gold, which he did, from $20 an ounce to $35 an ounce. He did do that. But the way I think about it, no, gold was just gold. An ounce of gold is an ounce of gold. What he did was he devalued the dollar by 75%. And nothing happens in isolation.
And this is the big point that Jim is making. Gold is gold.
Gold is gold. So if you
Prices going up and down, it has more to do with the dollar than the gold.
Correct. When I see the price of gold go up, I say, well, the price of gold didn't do anything. What happened was the dollar went down.
Right.
It takes me more dollars to buy my ounce. The dollar has devalued. It all depends how. If you think the dollar is the standard of everything and you measure everything in dollars, then yes, gold goes up or down. But if you flip that and say, let me make gold the standard. Let me take an ounce of gold, and that's my yardstick. That's my measuring stick. Then what you realize is that changes in the dollar price of gold are really changes in the dollar, not in the value of gold.
And this is another big point where, again, intelligence is, if you agree with me or not, is Kim and I own a lot of gold and silver, coinage and stuff like that. We don't have ETFs, no paper gold.
Right.
But we also don't see gold and silver as an investment. And why you say the same thing. Why do you say that?
I agree with that completely. Gold is money. And another one of the criticisms of gold is like, well, I don't want gold because it has
you
no.
catch hell for that one.
I know exactly. They say, I don't want gold because it has no yield. Warren Buffett's the king of. Everyone thinks he's a great stock picker. He made a few good calls, but Warren Buffett is really the king of tax deferred compounding. He realized at a young age the power of compounding. So Warren Buffett's all about yield, and that's fine, assuming that the things you're investing in don't go to zero, which occasionally they do. But so gold has no yield. That's true. But my point is, it's not supposed to have a yield. It's money. Money doesn't have a yield. Reach in your purse or wallet, pull out a $20 bill, hold it in front of you, and say, "What's the yield?" Zero. There is no yield on a $20 bill. And you say, "Oh well, I can get a yield by putting it in the bank." Well, it's not money anymore. When you put it in the bank, that's not money. They call it money. The Fed wants you to think it's money. It's an unsecured liability of an occasionally insolvent financial institution. In other words, it's an IOU from the bank. Okay, you got
They have to pay you something for the risk.
Correct. That's the point. So
that's a big point. Say there's no risk in gold by itself.
If
the price may fluctuate.
Right. If I have a $100 bill, it's always going to be a $100 bill. Right. It may buy more or less in the future, but it's always going to be a $100 bill. If I have an ounce of gold, it's always going to be an ounce of gold. So they don't have any yield because they don't have any risk. But the risk is when you put your money in the bank, you put your money in a so-called money market fund. And you run into people who go, I've got money in stocks, I've got money in bonds, I've got money in real estate. I say, no, you don't. You have stocks, bonds, and real estate, but that's not money. If you want money, you have to sell the stocks, bonds, and real estate to get the money out of the system. And when you do that, guess what? Everyone's doing it at the same time. The price is collapsing. Your wealth is disappearing in front of your eyes.
Once again, it's Robert Kiyosaki of the Rich Dad Radio Show. Our guest in studio today, which I'm very honored, humbled, is James Rickards. He's a global chief strategist. He's really a futurist. That's what I call him. And his latest book is The Road to Ruin, the Global Elite Secret Plan for the Next Financial Crisis. We still haven't got into that one yet, but we're explaining what the logic is for calling gold, and we're not saying it's going to happen, so don't invest on this. $10,000 an ounce gold, when today it's around $1,300 plus the royalties up to $1,400 for U.S. Eagle. But anyway, it's the logic. It's why is he calling for 10,000 an ounce gold? And if you knew it was going to go to 10,000, what would you do? If the bank's going to give you 1.2% in a money market certificate, which would be a tragedy, would you still keep it in the bank? And there's a reason to keep it in the bank. So it's not an answer thing, because we're probably going into a liquidity trap right now anyway. So all of these things are covered in this book, The Road to Ruin. And Kim has seen me. I've read the book. I studied the book, but she's seen me walk around the house with my Bluetooth headphones on, listening to The Road to Ruin. And it takes me about a week to get through all those chapters.
But I got to say, as a result of The Road to Ruin, Jim, as I was listening to some of your interviews this morning before the show, I said to Robert, I'll guarantee you after this interview with Jim that we're going to make some changes and we're going to end up buying more gold and we're going to be changing things with the banks and we're going to be doing all this stuff again, which is fantastic. I mean,
and she came out of the room flying. Her hair was on fire. So I was watching Jim. That was this morning. But anyway, the big thing was I was moving because our problem is too much cash and we don't know where to move it to.
Right. So
we go to each bank and we take it up to $250,000 FDIC. Hopefully they'll still be there, counterparty risk. But it's really a problem. Do you know what I mean? It's really a problem to have cash. So, but this is the point. And every time we got there, the bank always said the same thing, which was put it into...
Wouldn't you rather put it into a money market where you get more interest?
Right.
We kind of laughed at the more interest thing anyway because you're talking about 0.1.
But what is wrong with a money market?
Well, money market funds is one of the great misnomers in history because it's not money. They're selling you a money market fund, but it's not money. It's a fund. So you're getting a share or a unit in a fund managed by a third party, not FDIC insured. And then you have to ask yourself.
That's the catch, isn't it?
Correct. It's not FDIC insured. It's not a bank product. They might sell it to you in the lobby of the bank through their brokerage arm, but it's not a bank product. Then you have to say, okay, who's behind that money? The so-called
who's
money
the counterparty?
Fund? Correct. What are they? I'm giving them my money. What are they doing with the money in the money market funds?
So we come back. Again, the question is, if you could, the song is I Can See Clearly Now, if you could see that gold was going to go to 10,000 and today it's around 1,400, 1,300, and not in ETFs, stay out of those things like GLD and SLVs. But we're going to be talking about what is the logic behind it. And when we come back, we'll be with James Rickards again, and we'll be talking more about what's really going on in the global economy.
You're listening to the Rich Dad Radio Show with Robert Kiyosaki.
Don't be like Charlie. Charlie is that do-it-yourselfer who does himself in. Do-it-yourself is good for tile and grout. It is not good for asset protection. Charlie thought he'd save a few dollars forming his LLC online. With no guidance, he did it wrong. When he sold the property, he lost thousands and thousands of dollars. He did himself in by trying to do it himself. Don't burn yourself. Use Corporate Direct to set up and maintain your LLCs and corporations. Corporate Direct is owned and operated by attorney and rich dad advisor Garrett Sutton. Garrett wrote the bestsellers Loopholes of Real Estate and Start Your Own Corporation. He is Robert Kiyosaki's attorney for asset protection. He and his team will do it right. Visit them at corporatedirect.com or call 800-600-1760. Mention Rich Dad and receive $100 off your formation fee. That's corporatedirect.com. corporatedirect.com.
Financial freedom begins with financial education. Now back to Robert Kiyosaki and the Rich Dad Radio Show.
Welcome back, Robert Kiyosaki, the Rich Dad Radio Show. The good news and bad news about the future. Very honored today to have James Rickards in our studio today because we've been teasing you about if you knew that gold was going to go to $10,000 an ounce, and today as we're speaking it's around $1,300, $1,400 with the premium on it, what would you do? Would you keep the money in the bank or would you go run and buy some gold now? And we're not saying to do that, but it's about being clear on what's coming in the future. So once again, you can listen to the Rich Dad Radio program anytime, anywhere on Android or iTunes, and all of our programs are archived at richdadradio.com because repetition is how we learn best. So if you listen to this program once, then go to richdadradio.com, dial it in, listen to it with your friends, family, and business partner, and discuss it because it'll make more sense the more you repeat it. And Kim knows, as I've been walking around our house listening to James Rickards because I read the book, I read all his books, but The Road to Ruin was the most shocking because it was the clearest because I could see the future from there. And it took me a while to grasp it because it's not just one thing. The price of gold is just a reflection of what's happening underneath all of that. So Kim and I are just honored to have James Rickards in our studio today. And once again, his website is jamesrickardsproject.com and maraglim.com. And also you have a newsletter, don't you have?
Yes, I have a couple. Strategic Intelligence is the main newsletter.
Okay.
From Agora, yeah.
Any comments, Kim?
Well, we're talking about gold going to 10,000. So you actually do have the math behind that.
Exactly, Kim. And as I said earlier, I don't like to debate claims. I like to do the analysis. So this is actually very simple. You can do this at home. It's like 7th grade math. There's no calculus involved. But here are the facts. If you take the major economies, so U.S., Europe, Japan, and China, how much money do they have? Well, their money supply is about $24 trillion. That's how much money is in the world from those major economies. How much gold do you need to restore confidence? That was what we were talking about. It's debatable, but I say 40%. Throughout the 20th century, the U.S. backed the money supply with 40% gold or more. So let's just take 40%.
Oh, it was 40%, not 20.
Correct. It was 20% in the 19th century gold standard of the British, but 40% in the United States. That was by law until 1965, by the way. Lyndon Johnson changed it. So let's just take 40% because there's good historical precedent for that. So 40% of 24 trillion is 9.6 trillion. So you need $9.6 trillion worth of gold to back up the money supply with a 40% backing. How much gold is there? Official gold, 33,000 tons. So just take 33,000 tons divided by $9.6 trillion, and you get $9,000 an ounce. But they keep expanding the money supply. So just when you go hunting, you don't aim at the target, you lead the target. So $10,000. That's the price the gold would have to be to support the money supply without deflation. It's that simple.
Okay, good. And one more thing is you're very concerned about China stockpiling gold.
I am. And China and Russia both have tripled their gold reserves in the last 10 years. And when we did the financial war game for the Pentagon in 2009 with a partner, this is the scenario we played out. Now, we got laughed at. We got ridiculed. There were people, why are you putting gold in this war game? Don't you know gold's not money? But we warned the Pentagon that Russia and China were in the red zone, going for the end zone by stockpiling gold so that they could do a gold-backed money scenario. It has played out exactly the way we predicted. As I say, they both tripled their gold reserves. By the way, but from 2014 to 2016, when the price of oil was collapsing and Russia lost $200 billion of reserves, they never sold an ounce of gold. In fact, they kept buying. They sold dollars, they sold euros, they sold everything else. But they kept buying gold even when the reserves were drawing down. Now the reserves are going up again, and they're still buying gold.
So let's go to one more subject that's important is, I call you a futurist. Now there's different ways of predicting the future. And academics look at the future, driving into the future with their hands on the rearview mirror. That's my analysis.
Right.
And people also say every military general fights the last war, but they don't see the new war coming.
Right.
And one of the things I loved about the Road to Ruin, you talked about the difference between the bond market and the stock market, and there was a massive flash crash on October 15, 2014. Mm-hmm. And the average person doesn't. What does that mean? What does the bond market crash mean? And that's is where Bayesian forecasting. So there's academic forecasting and Bayesian. So as a Bayesian forecaster, when you see this flash crash in October 15, 2014, how does your logic system kick in versus an academic like Janet Yellen or Bernanke?
And what is Bayesian?
Exactly. You make a very good point, Robert. So if you're going to do forecasting, you need some methodology or some model. It's not a crystal ball. It doesn't work. You can't guess. That's actually dangerous. You need a rigorous model. And most people, most academics, and Janet Yellen very famously, use statistical methods that involve lots and lots of data, more data, more data, more data. If they don't have enough data, they don't forecast. They say we don't have enough to do this.
And that's what I mean. They're driving into the future, looking in the rearview
mirror.
mirror.
Correct. So they're looking at the past, saying, "Get me piles and piles of data. I'll do what they call regression. Comparisons of one thing to another. What's the relationship?" And then that's the basis for my forecast. First of all, that's junk, because quite often we're surprised that things happen in the future that are very different than what happened in the past. That's complexity theory.
Especially now.
Correct. That especially now. That's part of what we do with our.
I don't think Janet saw 9/11, did she?
No, she didn't, and neither did the White House. But more importantly, Janet didn't see 2007, didn't see 2008,
real estate.
and neither did Ben Bernanke. Bernanke's walking around in the minutes of the Fed in the spring of 2007, which was pretty late in the game, saying, "Oh, this housing crisis will blow over; it'll be contained." Right. They had no clue, none at all. So let's talk about Bayesian forecasting, which I learned in the intelligence community. Robert, I think you
learned in the military.
You learned in the military. This is what you do when you don't have enough data, but you have life or death problems. In other words, just because you don't have enough data, you can't throw up your hands. If people's lives are at stake, which is what the military and the intelligence community confront, you have to do something. Now, Bayes, there was a real person, Thomas Bayes. He was an 18th century minister in England, but he was a pretty good mathematician. And he invented this formula. The formula is over 200 years old. There's nothing new about it, but it has never been used in finance. It's been used in the military and intelligence, which is what we talked about, Robert, and where I learned it. It's been used in a lot of applications. So how does it work? Basically, you say, look, okay, I don't have enough data. I always say, look, if you have enough data, a smart high school kid can solve the problem. How do you solve the problems when there's not enough data? That's much more of a challenge. So what you do is you make an estimate or a guess, the best you can. You know it's a guess. You have to be very humble about that. But you say, based on what I know, based on some history and a little bit of data, here's what I think is going to happen. But then here's the hard part. You test it rigorously with subsequent events. And this is what the Janet Yellens of the world hate. They say, wait a second, you're forming a hypothesis with not enough information, and then you're going to test it on future things. Too bad. That's the way it works. This is how you find missing aircraft, missing submarines. So I faced this problem at the CIA. We were doing counterterrorism, and it was after 9/11, and we were trying to predict the next attack, the next spectacular attack. And Janet Yellen said, would have said, hypothetically, well, let's wait for 10 more attacks, and then we'll have 10 data points, and then we can do the regressions and all that.
That's good
strategy.
So
30,000 dead Americans while you're trying to do your statistics. We had one data point, but we had to so we formed hypotheses. But then as new facts come in, here's the key thing. You ask yourself a question. What is the probability or the likelihood that the subsequent thing would be happening if my original hypothesis were true or false? You test the validity of the first guess based on the correlation with subsequent things. And if they validate it, then you raise the probability. You go from 50 to 60 to 70 to 80. If they invalidate it, you lower the probability, and at some point you abandon it. So you abandon the bad guesses, just put them to one side, try again. The good guesses get stronger, and that's the basis for your forecast. And I stood in the London Eye on June 20th, 2016 in London 3 days before Brexit, and I said, they are going to vote to leave. And that was completely out of consensus. Nobody saw that coming. In the days leading up to the election, on November 6th, 7th, 2016, I was in television studios live around the world. I said, Donald Trump is going to win this election. I got laughed at. I got ridiculed. But those were completely out of consensus. But they were not guesses. I was using this technique that I just described. It's the same technique I use to forecast $10,000 gold. It's called Bayesian statistics. Very powerful stuff. And
So you're predicting ICE 9. What is ICE 9?
ICE 9 is a phrase that I borrowed from the great novelist Kurt Vonnegut. He wrote a novel called Cat's Cradle, which I highly recommend. This is in the early 60s, around the time of the Cuban Missile Crisis. So in a nutshell, there's a scientist who invents a molecule, and it's just like water, except for two things. It has a much higher melting point, so it's frozen at room temperature. And if it comes in contact with regular H2O, it turns the H2O to ICE 9. So he put it in vials, gave it to his kids, and the plot is if you open the vial and poured it into a stream, the stream would turn to ice, the bay would turn to ice, the ocean would turn to ice, the entire planet would freeze, and life on Earth would die. It was a doomsday machine based on this one molecule. But I use it to as a metaphor for how contagion spreads, how financial contagion spreads. It starts in money markets, then it goes to the stock market, then it goes to the bond market, then it goes to real estate, and it takes everything down with it. Now, in the last crisis in 2008, what was the response to that? We started going down that road. Mm-hmm. Those contagion markets were crashing. The response was print money. Ben Bernanke guaranteed every bank deposit in America, guaranteed every money market fund in America, did $10 trillion of swaps with the European central bank to bail out Europe, et cetera. They just printed money, spread the guarantees around, and we got through it. In the next crisis, here's the problem. They're not going to be able to do that again because they've never normalized their balance sheets. The Fed took its balance sheet to $4 trillion. If they got back to $1 trillion, I say, okay, you could do it again. But they didn't. They're still at $4 trillion. They can't do it again. So what are they going to do when this panic breaks out?
Wait, why can't they do it again?
Because back to what we were talking about earlier, Robert, the confidence boundary. In other words, $4 trillion, what are you going to do? Go to $8 trillion? 12 trillion, 16 trillion. At what point do people lose confidence? At what point do people say, I don't know what you guys are doing. I'm out of here. Get me out of dollars. Get me into everything else. So the Fed, by the way, the Fed is trying to reduce their balance sheet right now. They're actually destroying money, but they're doing it very slowly, not in time for the next panic. So, but the Fed understands that there's a limit. We don't know exactly what it is. I can't tell you if it's 4.6 trillion or 5 trillion, but it's there somewhere. You're going to break the confidence in the dollar. So they can't go there.
So what will you?
That
What do you think?
Print that much more money.
Correct.
So what do you see?
You're assuming people
coming?
are that intelligent.
Well, there's when I
Early guys are that intelligent.
I like to say, Robert, when it comes to your own money, everybody has a PhD. People are pretty smart. They might do this intuitively. They might not have PhDs in economics, but people get it. They know that something's wrong. If they see the Fed doing that, it'll be on the blogs and the websites and Twitter and the nightly news, and the people will get it, and they will back away from the dollar. And the Fed knows that. Why would the Fed be reducing its balance sheet today if they didn't think there was a confidence boundary? If they didn't think they had pushed it too far. So then, so now you have the panic, you have the contagion spreading like wildfire. You can't print your way out of it, or at least not quickly. So what do? You lock down the system. That's ICE 9. It'll start.
That's what happened in what you saw in Crete or
Cyprus.
It happened in Cyprus. It happened in Greece.
They shut down all the banks.
Correct, and it happened. You're right about Cyprus, Robert, but it also happened in Greece. There were Greeks in Athens. They were flying to Frankfurt, getting suitcases full of euros, flying back because the ATMs were shut, the banks were shut. They wouldn't take credit cards. If you were a foreign tourist at the airport, okay, maybe your credit card worked, but the Greek, those people, their credit cards did not work. People couldn't pay for anything. They were reverting to barter, and as I say, they were smuggling in like paper euros, banknotes, to Greece so they could just buy food for their families. So that's what ICE 9 looks like, and people say, well, it can't happen here. Well, of course it could. In 1933, by executive order, Franklin Roosevelt closed every bank in America. Closed. And he didn't say when he was going to reopen them. Now, they happened to reopen about 8 days, but he didn't say that at the time. He said, we'll get back to you, American people, and then they came up with a plan. But today, you wouldn't even need the executive order. Just throw a switch and shut down the ATMs.
So that's why you don't recommend people holding anything in the banks today, because they can shut down the banks.
Correct. Now, if you have a lot of cash, you can't pile it under a mattress, and the bank won't let you anyway. Try getting a lot of cash out of the bank.
No, they don't have to.
Well, first of all, you might have to come back by appointment. They'll file a currency transaction report, put you in a file on the Financial Crimes Enforcement Network right next to Osama bin Laden, et cetera. So you can do it, but it's extremely awkward and lots of reports, lots of paperwork, et cetera.
So that's why you're saying open accounts of $250,000 or
Correct.
less per bank.
So have some cash just for like you'd have battery and flashlights for a storm. But $250,000, that's the FDIC insurance limit. You get to that limit at one bank, go to a different bank. That's fine. Each one is insured individually. I wouldn't be completely confident in the FDIC itself.
Yeah.
Bailing it out.
Where are they going to get the money
Exactly.
beyond a certain point? But as a practical matter, you do have to do that. You're right, Kim. But this is where gold comes in, because physical gold in a safe place.
Not in a bank.
Not in a bank. Don't put it in a bank deposit box, because that's the first thing they'll close. There's what's called a conditional correlation. The time you want your gold the most is when the banks are going to be shut.
But this is also why you say having cash is good too, because there's going to be a liquidity crisis.
Correct. And
If everything you say is coming true, there'll be a shortage of cash too.
That's right. Well, actually, it's happening in India today. I saw a news article just in the past couple of days where everyone is taking their money. Everyone in India is taking their money out of the ATMs. There's a run on cash because they're worried about the solvency of the banking system. Now, bear in mind, it was just 2 years ago that the Indian government outlawed cash, physical cash.
They canceled some money.
They canceled. You had rupees in your wallet or purse, and they said this is no longer money. Bring it down to the bank, turn it in. We'll give you a different kind of money. Of course, the tax inspector is waiting there. It turns out that tax evasion actually wasn't that much of a problem. The Indian government thought they were going to flush out all these tax evaders. Turns out people just like cash. You'd pay for your supplies or whatever. So that was a red herring. But that was a searing experience for the Indians. But now Now the new money is issued, and they're taking that out of the ATMs. So they're starting to shut the ATMs. So Einstein is happening all over the world. I think Americans are naive and overly complacent if they think it can't happen here. It has happened here, 1933. Hurricane Sandy in the East Coast. There's no electricity. ATMs don't work without electricity. So have some gold and silver.
We could go on and on and on and on, because being a futurist and all this, it's just interesting to see it. Please read his books, James Rickards' books, Currency Wars, Death of Money, New Case of Gold, and The Road to Ruin, because the object is we're not giving you answers, we're teaching you how to see the future, because James Rickards is the raven. The raven is the symbol for prophecy throughout history. So anyway, I thank you, James, because we're at a very crucial time in history. And thank you for your contribution to us. Final words,
Thank
Kim?
you. I just want to say Ask Robert will return next week. So please submit your questions to AskRobert@richdadradio.com.
I'd rather ask Jim, not
I
ask
know. Me too. And there's so much we can talk
God.
about.
Oh.
And we'd love to have you back, Jim, because there's just so much going on here, and we barely scratch the surface.
Well, thank you, Robert. Thank you, Kim. Great to be with you. Would love to come back.
Yeah, and
thank
now we're
you.
going to go out and buy more gold, and we're going to do stuff with our money, and here we go.
Yeah. And then don't buy gold ETFs, which is GLD, or SLV for silver, because it's the same problem with paper. Thank you very much, and thank you for listening.